Welcome to the Wealth Setting Podcast. This is episode 495. Today is October 13th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, hey, all that panic with the big selling on Friday and then the talking heads predicting all kinds of gloom and doom over the weekend, and yet today, what did we see in the market? It all rebounded. We effectively had another day of one-day panic selling on Wall Street, and now no one seems to care again. Now, I've been quiet the past few weeks because, I really haven't had anything to say. I keep holding my positions. I know valuations are high, but the counter to that is that growth rates are also higher than historic norms anyways. And so to some degree or other, that does justify the high valuations we're seeing for stocks right now. So while I'm always cautious and concerned, I remain optimistic, actually cynically optimistic, and I'm really not doing anything new or different in my portfolio. I still am holding, 130 some plus stocks. We're going to talk a little bit about that today. But I also have been building up cash reserves because I do think we're overdue for some type of a pullback or correction. But I was really hoping that this panic that started on Friday would carry on for a week or two so I could put some of my cash to work. That doesn't seem to be the case. And that really goes to show you how strong the underlying strength of this economy really is. I mean, you can't really turn on any type of, whether it's mainstream media or alternative media, you can't turn on anything without hearing nothing but gloom and doom. Now, they come from different angles, but everybody seems to want to predict the next recession or the big stock market crash. And it simply is not coming, or hasn't happened yet. I put out a post yesterday on Sunday where I showed a chart of the S&P 500, and I pointed out there that, over the last couple years, unless there's been a major tsunami of an event occurring, like when interest rates suddenly spiked and went up to 5% on the 10-year Treasury back in, I think that was November of 2023. Yeah, we had a pullback in the market, fairly substantial. Didn't last long, but it did drop down to maybe the 200-day moving average or so on the S&P 500. We saw a similar event happen on Liberation Day in April of this year, when for some reason, although Trump had been consistently talking about tariffs, nobody seemed to believe him until he put them in place on April 2nd. And then, of course, we had a big meltdown in the market. Again, didn't last very long, but it was a significant pullback and it dropped well below the 200-day moving average. But other than those two events in the last 2 years, we've seen the S&P 500 with very shallow pullbacks, never lasting really more than a few days. And other than those two exceptions I just talked about, they've never really gone below a certain weekly harmonic. And what I mean by that is it's a particular moving average that tries to model the low points over a period of time. In any case, I pointed out that if we were to drop to that level, then we'd be seeing a little more than an 8% drop in the overall S&P. That would technically be not even a full-fledged correction, which is usually a 10% drop. And in either case, I mentioned that if it happened, I would see it as a great buying point. I would most likely jump in and buy before that level anyways because of the shallow and the quickness of these pullbacks that we've seen. And furthermore, we didn't even get that opportunity. A day after the panic, the markets are back up. And we'll see how that continues to hold. But bottom line, again, imagine if there was at least a little bit of a media coverage or media narrative that was positive, how much even better this market would be. Because even myself, when I was concerned over this summer, I thought we'd see a decline in earnings, and I'm not talking falling off a cliff, but there was a good indication we were only going to get about a 6% corporate earnings rate over the summer for the second quarter when it was reported. And while that's not a bad rate, we had been at double digits in the first quarter. And so my thought process is that since the media narrative is so negative to begin with, they would come out after second quarter earnings came out and they would be talking about how, earnings have fallen off a cliff. They're down 50% from what they were, yada, yada, yada. Well, as it turns out, the media couldn't do that because corporate earnings came back in at double digits. And they're likely to hit that number again for third quarter. In fact, look at what third quarter GDP is projected to be. Well above 3% growth. And this is in an economy when they've been telling you that we're headed for a recession any day. I digress. Listen, in this episode, I want to point out the most important thing in the market that we're in right now. And that's that the leadership continues to lead. When I look at my portfolio of stocks, I'd say about 80% of the ones that have been doing well all year have not only done well all year, but they've done well in the past, quarter, they've done well in the past month, and they've even done well on a relative basis over this last week when we saw a great deal of turbulence. Now again, I own 130 some stocks. I'm not concentrated in the Mag 7 like some people are. And if you're specifically in the traditional S&P 500, then you are pretty concentrated, maybe not in a handful of stocks, but certainly within about 10 or 12 stocks. And that's much more of a risk tolerance than I personally want to take, even if it tends to outperform. The other thing about not having all the exposure to the Mag 7, and even though I talk about leadership continuing to be leadership, it's not about the leadership that the media continues to talk about, right? I mean, they talked ad infinitum about the Mag 7. Mag 7 hasn't done so well this year. In fact, when I look at the Mag 7, I own most of them. I don't own Tesla. I don't own Apple, maybe another one here and there. But when I look at the Mag 7 within my portfolio, only 2 of the Mag 7 are in my top 40 performing stocks. And they're way down at the bottom. Netflix comes in at number 33, and Google is my 39th best performer for the year. And those big hyperscalers that we've heard for years about, Meta and Microsoft, well, yeah, they're barely in my top 50 performing stocks for the year. Meta's at like 49, Microsoft is at 50. And even though most of my portfolio is focused on, broadly speaking, the artificial intelligence trade, I only have one semiconductor chip manufacturer that's even in my top 10. And no, it's not NVIDIA, it's AMD. AMD is right at my top 10th performing stock for the year. Oh, and I do own NVIDIA, in the Mag 7, but it's at number 29 in my overall performance. And hey, by the way, I'm not saying you shouldn't own companies like NVIDIA. I obviously continue to hold it. And you know what? Even though it's my 29th best performing stock this year, it's up 40% year to date. So, that just goes to show that you can get in late to these positions and they're still moving forward and you can still make money. But better than that, better than to just follow what's in the headlines, do you know what leadership is doing extremely well? And I'm going to talk about this not only in terms of what I own, but in terms of what I even don't own, which maybe I should. But the number one consistent performer all year long continues to be utilities. Now, if you follow me, earlier in the year I sold off a bunch of my utility stocks. Well, actually, I didn't. That's the bad way to say it. I didn't sell off my utility stocks. I trimmed back most of my positions. I only got rid of 3 specific utility stocks. I kept all the others, which is something like, 18 additional ones besides the ones that I sold off. And then within those, there were maybe a dozen or so that I cut back on. I didn't do it as much for market conditions as I did for portfolio management. My concentration in utility stocks was, well up into the 30% range. Now, they only make up something like 4% of the overall S&P 500. So for me to be that focused and that concentrated in utility stocks was getting to be, more of a lopsided risk in my portfolio than I wanted. Now, of course, 2020 hindsight, they've continued to do well. But I didn't know that, 4 months ago or so when I sold some of those positions. And even with that, I'm not unhappy with my overall performance because for the most part, even though I may have a 20% cash position, meaning I'm parking that money in a money market fund that's collecting at least 4% or better in interest, in some cases I may have closer to a 30% position as I trimmed and made some allowances in taxable accounts to try and offset that huge gain that I had by selling off utility stock. So what I'm trying to say here is that even though I could be sitting maybe 15, 20, 25 or close to 30% in cash positions in some particular taxable accounts. My day-to-day performance is pretty much keeping up with the major indices. I haven't been going down as much as, say, the S&P goes down, and I've been tending either going up as much as it is or maybe a little more. The days that I don't beat or outperform the S&P 500, well, then I'm comparable to, say, the Dow or the mid caps. So index comparison, I'm doing pretty well, even though I'm sitting on a nice chunk of cash that can be put to use if we do get a pullback, or for that matter, even if we don't. Again, I'm cautious, but I'm cynically optimistic that long term, these trends that we're seeing are going to continue. And while I don't want to be willy-nilly invested in the broad market, or for that matter, definitely don't want to be concentrated in a handful of stocks, I do want to own that 100+ stocks that are heavily concentrated in the leadership, which has been what I've called the convergence of industrials and technology. Because the reason that utilities are doing so well this year isn't as a safety trade, it's the fact that for the last generation or so, we've had virtually no major growth in electrical utilization. Well, now we're talking about doubling or tripling or more that need for electricity, and these big hyperscalers like Microsoft, like Meta, like Google, they're going out and making private deals, long-term deals, where they're willing to pay 3 to 4 times the going rate for electricity. And so that's not only pumping up the utility stocks, but even more so, it's the whole electrification trade. And it's not just all about data centers. Ever since the pandemic, seen a continued boom in industrial manufacturing, which is also putting a heavy load on the need for energy in general and electricity specifically. So the other major leadership that's doing well, and just we'll group these into the term of electrical components, anything from connectors to wiring to harnesses, and whether they be simple old analog copper wire to copper wire connectors or high-tech laser fiber optics. The whole spectrum of anything to do with electricity, electrical components, and electrification, these stocks are going gangbusters all year long, and they're even continuing to do well on a relative basis on these days we get pullbacks. You know what I own here. You've heard me talk about it many times this year, but that's companies like GE Vernova, Sienna, Corning, Amphenol, Vertiv Holdings. And in that mix, I haven't even talked about the nuclear energy or the uranium side of the trade, companies like Centrus Energy. Pull that up on a chart. They're the world's only privately held uranium refining company, and they happen to be headquartered here in the U.S. Oh, and let's see, there's Flex, Jabil, and then not specific electrical component companies, but Globestar, a satellite company that's hot right now because its technology will likely be key to tying in the whole Internet of Things as we advance more with artificial intelligence. And then there's the real nuts and bolts things in the economy, the companies like Southern Copper, which is a copper mining company. Bottom line is, this electrification trade that's second or third derivative away from the direct artificial intelligence or the big names that you hear of the hyperscalers like Microsoft or Meta, or the big chip companies like NVIDIA. Right? These other companies are far, far away in the supply chain, but they're still doing extremely well, and I think that trend is going to continue. And it's even the old technology within the computer hardware or the computer memory space area. I think right now my number 2 and number 3 stocks in my portfolio are old school, old technology, Seagate and Micron. Those stocks are well up over 100% year to date, and I don't think they're overvalued at this point, because if you look at their forward earnings, they're not at these 30 or more times earnings like the big hyperscalers. I think Seagate is right around 15 to 16 times earnings, and Micron is maybe like 10 or 11 times. So there's potentially still a lot of room for these leaders to run. And I've just been talking about stocks I own, and I don't own the universe of great stocks. Some things that have done really well, especially in the last 3 months, that are way underrepresented in my portfolio, and that's biotech and insurance companies. Now, I think I own maybe 1 or 2 biotech companies, so I'm way underexposed there, but I generally do shy away from biotech. It really is, outside of a lot of my risk. But pull up some of the bigger names in biotech. Look how well they've done. That might be an area you want to go into. Insurance companies, again, I own a couple, but I'm way underrepresented there. And there are some companies that have been underperforming, but again, over the last 2 or 3 months, they look like they might be improving. That could be new leadership moving into 2026. Take a look at a company like Aflac. I don't own it. I don't have any intention of buying it anytime soon, but it does look interesting. And there's several other of these very stable, high-quality insurance companies that, maybe it's time to add to your portfolio. Finally, the last one of these areas I want to comment on, and it looks like they're getting a breath of fresh air, and this is broadly, I'll call it software as a service, or these software application companies. The thesis for at least the last 18 months or so has been that artificial intelligence is going to just eat these software companies' lunch. So companies like Adobe, which has been, a generational leader, has just totally been in the tank the last couple years. Salesforce is another one. Yeah, take a look at some of those software application type companies. Salesforce in particular, it is in my portfolio. Looks like it's getting a breath of fresh air. And maybe that universal negative media narrative that these software companies can't compete in artificial intelligence, well, maybe that's been overblown. Let me think of some others in that area. SAP, not currently in my portfolio. I wouldn't mind it being there. That's a German company. Application software, they did really well about a year ago. They've stagnated. They look like maybe they've bottomed out. Intuit's been a long-term holding in my portfolio. Again, it has underperformed the market as most of these software companies have. I still like it. I think it could have maybe put in a multiple bottom here and the worst is over for it. Autodesk, another one that I don't own, but yeah, might have a place in my portfolio. Roper Technologies, definitely one that's on my watch list. And let me throw in 2 more. Workday is in my portfolio. Definitely been an underperformer. I think it might have bottomed out. And Tyler Technologies, one that isn't in my portfolio, but again, on my watch list. I think maybe the worst is over for it, as well as these other software application companies. Hey, in any case, the bottom line, the economy is generally sound. The United States in particular, despite all the bad news you hear, remains among the best and the strongest and the most resilient economies in the world. That's not changing anytime soon. I'd advise you to just ignore what you hear in the headlines. If we get a pullback or on these days when there's panic, it's probably a good buying opportunity, because as long as you're investing in good, quality, fundamentally sound companies, and especially if they're attached to one of these long-term trends like electrification, and if you're willing to hold them over the long run, I think they're going to do just fine. But hey, we'll find out. Come back for future episodes. Until then, as always, this is John Pugliano wishing you the very best returns.